Hello and welcome back to our channel. In our last video, we looked at how important it is to understand some of the basics of human psychology if you want to succeed as an investor. And we also looked at another really important thing called the break-even fallacy. This is just about how the maths works at the most fundamental level when it comes to calculating percentage returns in investment, with the main point being that if something you own falls 50%, you'll then need it to go up 100% to get back to where you started, not 50%. This idea is pretty poorly understood, but it is also pretty important to understand. So do please check out that video if you missed it. And as I promised at the end of that last video, today we're going to look at something called sequence risk. This is arguably the key risk in investment which almost no one understands, including quite a lot of the people who work in the finance industry, by the way. This is bad news because sequence risk can make a huge difference to your ability to become wealthy. Without exaggeration, it can have a six-figure impact on the pot you end up with in retirement, even if you're on an average British salary. And if you're a particularly high earner, it could even have a seven-figure impact. So what on earth is it? Why does hardly anybody know about it? And how come the investment industry almost never talks about it? In today's video, we'll answer these important questions. So, sequence risk is the idea that the order of your returns over a lifetime of investing can matter more than your average returns and also the volatility or risk of your returns. That's when it comes to building real wealth in the real world, at least. This might sound a bit complicated, but it is sufficiently important to merit an attempt to explain it as best I can in plain English. The idea of sequence risk is so unusual in investment thinking that it requires a couple of simple numerical examples to illustrate. So we'll start by looking at how it might affect you in the accumulation phase of your investment journey. So that is as you save and invest from roughly, say, your 20s onwards, ideally, until you can live on the money you've built. Let's take the example of a 30-year-old who's managed to save £10,000 by the end of their 20s. I'm also going to assume that they're able to save and invest £500 a month from that point onwards. And by the way, the concept is easier to explain and comes across more powerfully with bigger numbers, so please forgive me if this seems like a quite punchy savings assumption. I appreciate that someone will need to be on a pretty decent income in order to be able to invest £500 a month. But the impact of sequence risk is just as valid with smaller numbers, but isn't as easy or powerful to show the impact. And I'd also point out that £500 a month might be a number that many couples can aspire to save together, i.e. perhaps around £250 a month each. Next, I'm going to assume that this person is able to make roughly equity market or stock market returns from the age of 30 to the age of 60. We will therefore assume that this is 7.5% a year, which is roughly what many equity markets can deliver in the long run. So in our example, our 30-year-old is starting with £10,000 and saving £6,000 a year at £500 a month, and they're making 7.5% returns. Now comes the really interesting bit that all too few people understand. Let us assume that 1 year in those 30 years, and only in 1 year, this person suffers a big stock market crash. The S&P 500 fell around 38% in 2008, so I'm going to use that number for the purposes of illustration. So the table we're showing on screen here shows you how this person will build real wealth given the assumptions we've made, but illustrates the significant difference that results from the order in which those returns happen. I've highlighted the impact of that 38% down year in orange in each of 4 scenarios. And these are whether someone suffers that big loss at the age of 30, 39, 49, or 59. The 5th scenario on the rightmost column shows this person's progress if they don't suffer that big 38% loss at all in any year. And you can see that if they had that large 38% crash year when they're 31, they will end up with a pot of nearly £671,000. If, however, they are unlucky enough to experience that massive fall at the age of 59, they will end up with a little less than £411,000. That is a difference of around £260,000. The person who endures a big stock market crash the year before they retire will be nearly 40% worse off than someone who suffered it as they were just getting started on their investment journey. And of course, they will be even better off if they manage to avoid having a big down year at any point on the journey and will end up with even more, as you can see in the rightmost column in green. The more you're able to save and invest, the bigger the difference can be. So this sequence risk could make a large 6 or even 7-figure difference to a highly paid professional over 30 years of investment, which is why it is so important to understand. Crucially, all of these scenarios have the same overall average percentage returns and volatility because the person averages 7.5% for 29 years and has one 38% crash year 1 year, apart from the rightmost column where there is no large down year. But as you can see, there's a very significant difference in their actual real-world outcome in terms of wealth. This is sequence risk. It's actually just a simple function of how the maths work and of the break-even fallacy that we looked at in our last video. In my experience, this reality is seldom, if ever, addressed by fund managers or by the financial press. It is arguably the most important investment concept which far too few people understand or take account of in their thinking. So we've just seen the very large potential variation in your likely real-world outcome as an investor caused by sequence risk on the way up, i.e. as you save and invest in the accumulation phase of your life. Let's now consider the same concept with respect to what may happen in retirement, otherwise known as the decumulation or drawdown phase of your life. So we're now looking at someone's real-world experience from the age of, say, 60 to, let's say, 90. And let's assume that they've managed to build an investment pot of £500,000 by the time they turn 60. This is something that is entirely possible for anyone who starts their investment journey early enough and invests sensibly, by the way, as you can see from the table we showed a minute ago. So let us also assume that this person has paid off their mortgage and can live reasonably well on, say, £25,000 a year. So they want to take this amount of cash out of their pot each year. That is to say that they will withdraw £25,000 a year. We'll keep the average annual return and terrible crash year assumptions the same, just as before at 7.5% a year and minus 38% when the crash comes. And here is another table to show what happens with these assumptions from the age of 60 to 90. Again, you can see the crucial difference in the order of returns in retirement too. Here, if someone is unlucky enough to experience a big crash year when they have just retired, they will then run out of money before they turn 85, shown in the left-hand column. In contrast, if a crash doesn't happen until they're 80, they will still have nearly £783,000 by the time they turn 90. What a difference. Most significantly, if they never suffer a big crash year at all, they will power on into their 90s with more than £1.5 million, as shown by the green box. Again, it's important to stress that the three scenarios on the left of this table have the same overall average percentage returns and volatility. But there is a very significant difference in the real-world impact on the individual's wealth, as you can see from the table. To be clear, I acknowledge fully that the numbers I'm using in these examples are not particularly realistic. No asset is going to give you a smooth 7.5% every year for 29 years and only one big down year. But what I'm trying to do here is show the very significant real-world impact that can result from this sequence risk in the most compelling way possible so that the point really comes home. And this is easier to do and comes across more powerfully with these simplified assumptions. These big differences to your real-world end result caused by sequence risk will occur with more realistic numbers in the real world. So that is sequence risk. And I wanted to cover it in some detail in today's video because, as I hope you will agree from your own personal experience perhaps, it is vanishingly rare ever to see this utterly crucial reality presented to you by the finance industry. And why is this, you might ask? Well, perhaps because there's no statistic or measure that can easily summarize this aspect of investing. Fund managers and financial advisors can easily compare themselves and market what they do with respect to percentage returns, and at the more sophisticated end of the market, risk or volatility adjusted returns over a relatively short period of time. But there's currently no league table for Master of the Universe fund managers to compare each other based on their ability to deal with this sequence risk. And to be fair, a big part of the reason for this is that the comparison needs to be made over very long periods of time, decades generally, and that's far longer than the standard 3 to 5 year performance numbers which most fund management companies use in their marketing. This does not change the fact that reducing the possibility of big drawdowns is certainly one of the key considerations when it comes to investment, and particularly as you approach retirement. A fund or other investment which might look fantastic over a period of 5 or even 10 years or more, but which then falls as much as 50% just ahead of your retirement, will have served you very badly in real terms. And this is why it's crucial to get your mix of investments right over time, as we've looked at a fair bit in the course of this video series overall. And by the way, before I sign off today, I'd like to point out that you can find all of this information in some detail and a great deal else besides in the fund overview document for our investment fund. It is a marketing document for our fund, of course, but I like to think that it is also a useful educational document about investment more generally. So please do check it out if you're so inclined. And I also cover all of these ideas in the new version of my workbook, Live on Less, Invest the Rest, which we hope to be able to publish next month, if at all possible, or failing that, early in the new year at least. And as another reminder, if you have purchased a copy of the original edition of that book, we will be offering you a free PDF and ebook copy of the new version once it's published. So please watch out for that. So that's it for today. I hope you found this video useful and perhaps even a little eye-opening. Sequence risk is a fairly important thing to understand, so hopefully this video has gone some way towards helping you on that front. As ever, if you want to ensure that you're one of the first to see our videos when they're published, please do click the subscribe and bell buttons. Please do also think about subscribing to our free email service from the Plain English Finance website. And if you'd like to hear from me more regularly, please do connect with me on any or all of LinkedIn, Facebook, and Twitter or X. And until next time, I wish you the very best.